Good evening. Tonight we are tracking significant developments across global commodity markets, with particular focus on silver and crude oil pricing, set against a backdrop of ongoing diplomatic negotiations between the United States and Iran in Geneva, Switzerland. On Thursday, February 26, 2026, silver prices recorded a decline of approximately $5 per ounce during morning trading sessions. The drop comes as silver had previously climbed from $32 per ounce to $91 per ounce over the preceding 14 months. Mainstream financial media outlets have attributed this morning's price movement to profit-taking activity by market participants following that extended rally. At the same time, crude oil is currently trading at $64.25 per barrel. This pricing is drawing attention from commodity market analysts, given the active state of diplomatic talks between United States and Iranian negotiators, which are ongoing in Geneva at this time. The United States President has publicly stated that if a diplomatic agreement on Iran's nuclear program is not reached between March 1st and March 6th, military options would be placed on the table. March 1st falls this coming Sunday, approximately 72 hours from the date of this broadcast. Physical silver dealer premiums, meanwhile, are reported to be holding steady. American silver eagles are currently listed at $4 to $5 over spot price, while Canadian maple leaf coins are carrying premiums of $3 to $4 over spot, at dealers surveyed as of this morning. We continue now with a deeper look at the market conditions and geopolitical developments that are shaping commodity trading this week. At the center of current market attention are the diplomatic talks taking place in Geneva, Switzerland, where United States diplomats and Iranian negotiators are engaged in discussions concerning Iran's nuclear program. The United States President has attached an explicit timeline to these negotiations, stating that if diplomacy does not produce results between March 1st and March 6th, military options are a certainty rather than a possibility. Analysts and market observers are noting that this timeline coincides directly with the current period of price movement in silver and other commodity markets. On the oil side, crude is presently priced at $64.25 per barrel. For context, when Russia invaded Ukraine in February of 2022, crude oil prices moved from $75 per barrel to $130 per barrel in less than 3 weeks. That conflict did not directly threaten Persian Gulf energy infrastructure. The current diplomatic situation, by contrast, involves Iran, a nation whose geographic position is directly relevant to the Strait of Hormuz, the narrow maritime passage through which approximately 30% of the world's seaborne oil traffic travels. Turning to silver's underlying supply and demand fundamentals, the Silver Institute has reported that global industrial demand for silver in 2025 reached an all-time record high of 654 million ounces. That figure is projected to reach 700 million ounces in 2026. Industrial applications driving this demand include solar panels, electric vehicles, and fifth-generation telecommunications infrastructure. Global silver mine supply, meanwhile, stands at approximately 830 million ounces per year and has remained largely flat over the past 5 years. Existing mining operations are also encountering declining ore grades, meaning greater energy input is required to extract equivalent volumes of metal. On the technical analysis front, institutional analysts utilizing Wyckoff methodology have publicly identified the next upside price objective for silver as a close above $100 per ounce. According to those analysts, should silver close above that level, $100 would transition into a technical floor, with the subsequent resistance level identified at $130 per ounce. We continue our coverage of the commodity markets with a look at additional financial indicators and the broader economic context surrounding today's developments. The current gold-to-silver ratio stands at approximately 60 to 1. Gold is presently trading at $5,184 per ounce, while silver sits at $86 per ounce. For historical reference, the average gold-to-silver ratio over the past century has been 50 to 1. During previous precious metals bull markets, that ratio has compressed further. At the peak of the Hunt Brothers silver squeeze in 1980, the ratio reached 15 to 1. During the post-financial crisis precious metals rally of 2011, the ratio dropped to 32 to 1. At the current ratio of 60 to 1, silver remains below its historical average relative to gold. Regarding conditions in the futures market, the COMEX exchange currently holds approximately 400 million ounces of registered silver available for delivery. Open interest in COMEX silver futures, however, represents over 1 billion ounces of silver. This means the paper market is leveraged at a ratio of at least 2.5 to 1 when measured against registered deliverable supply. That figure is reported to be potentially closer to 5 to 1 when unallocated bullion bank accounts and London Bullion Market Association forward contracts are factored in. On the monetary policy front, the Federal Reserve's overnight rate currently stands at 4.75%. The Federal Reserve's balance sheet remains at $7.3 trillion, which is described as more than double its pre-pandemic level. The federal debt has crossed $36 trillion and is growing at a rate of approximately $2 trillion per year. The M2 money supply expanded from $15 trillion to $21 trillion between 2020 and 2022 and has seen limited reduction since that time. In the broader geopolitical context, the October 2024 BRICS summit held in Kazan saw member nations, including Brazil, Russia, India, China, South Africa, Saudi Arabia, the United Arab Emirates, Egypt, Ethiopia, and Iran, announce movement toward a gold-backed trade settlement system designed to operate outside the United States dollar. Since that summit, China and Saudi Arabia have been settling oil contracts in yuan. Russia has been selling natural gas to India in rubles and rupees, and the United Arab Emirates has been purchasing Russian coal using gold-backed digital tokens. Historical price comparisons are also being referenced in current market analysis. In March of 2020, gold declined from $1,700 to $1,500 before rallying to $2,070 over the following 4 months. Silver fell from $18 to $12 during that same period, before recovering to $30 by August of 2020. These movements are being cited as precedent for the pattern of sharp price declines preceding significant recoveries in precious metals markets. As of Thursday, February 26, 2026, silver has recorded a $5 decline in morning trading, bringing the spot price to approximately $86 per ounce. This follows a 14-month rally that carried silver from $32 to a high of $91 per ounce. Mainstream financial media has characterized today's price movement as profit-taking. Physical silver premiums at dealers, however, remain steady, with American Silver Eagles carrying premiums of $4 to $5 over spot and Canadian Maple Leaf coins carrying premiums of $3 to $4 over spot. Crude oil continues to trade at $64.25 per barrel. This pricing is occurring against the backdrop of active United States and Iranian diplomatic negotiations in Geneva, Switzerland, centered on Iran's nuclear program. The United States President has stated publicly that if no agreement is reached between March 1st and March 6th, military options are a certainty. The Strait of Hormuz, through which approximately 30% of global seaborne oil traffic passes, remains a key point of reference in assessments of potential energy supply disruption. On the fundamental side, global industrial silver demand reached a record 654 million ounces in 2025 and is projected to reach 700 million ounces in 2026. Mine supply remains at approximately 830 million ounces annually and has been flat for 5 years. The COMEX paper-silver market carries open interest representing over 1 billion ounces against a registered deliverable supply of 400 million ounces. The gold-to-silver ratio currently sits at 60 to 1, compared to a historical average of 50 to 1, and levels as low as 15 to 1 during previous peak precious metals environments. On the macroeconomic front, the Federal Reserve's overnight lending rate stands at 4.75%. The national debt has surpassed $36 trillion. The Federal Reserve balance sheet remains at $7.3 trillion. And the BRICS nations have continued advancing a framework for gold-backed trade settlement outside the United States dollar system, with several bilateral energy transactions already being conducted in non-dollar currencies. Wyckoff technical analysis models cited by institutional analysts have identified $100 per ounce as the next significant resistance level for silver, with $130 identified as the subsequent target should that level be breached and confirmed as support. All of these developments taken together are drawing significant attention from commodity market participants and analysts heading into the weekend of March 1, 2026, and the ongoing diplomatic proceedings in Geneva. That concludes our coverage for this broadcast. We will continue to monitor developments out of Geneva, the crude oil market, and precious metals trading as this story progresses. For all of us here, thank you for watching. We will see you next time.